The coronavirus outbreak will, quite understandably, still be the focus of investors' attention in the week ahead, especially as macroeconomic and company news flow will be relatively quiet as we prepare for the long Easter weekend. Top down, the two standout items could come from the world's biggest economy, America, and both items are due out on Tuesday the 7th of April. They are the NFIB Smaller Business Economics Trends Survey and the JOLTS, Job Openings and Labour Turnover Survey. The last NFIB reading was 104.5. That maintained a run of scores over 100 that stretches back to December 2016, just after the election of Donald Trump as President of the USA. Make of that what you will, but it seems logical to expect a hit to smaller company sentiment thanks to the rapid spread of COVID-19 in America. It's just a matter of how big, and whether the fiscal and monetary stimulus packages offered by the American government and the US Federal Reserve are seen as being sufficient or not. Note also how the NFIB and the American Small Cap Russell 2000 Index have tended to move in lockstep over time, and the Russell has already taken a big leg down. As for the JOLTS survey, the last reading we got, January, was for 6.9 million job openings, which at least was an improvement on December. However, it did represent the sixth year-on-year decline in 7 months, and came in well below the 7.5 million peak figure from January 2019, as if to suggest the American economy had been cooling a bit even before the viral outbreak hit home. A further decline seems possible this time around, although it may not be until the March and April figures we get to see an extent of the slowdown. On the company front, the Financial Conduct Authority has lifted its moratorium on the publication of preliminary results statements. There's a select list of companies due to update shareholders, and we may also start to catch up on the reports that were held over, in addition to possibly seeing further unscheduled trading updates. On the scheduled list, the main names of note include online fast fashion player ASOS on Tuesday the 7th of April with its interim results. Then on Wednesday the 8th, we have Tesco scheduled to release its preliminary full-year figures. And then on the 9th, Fever Tree Drinks will publish full-year numbers. Of that trio, it's Tesco that could create the biggest fuss for me, although all of those numbers are likely to be of interest in their own right. As we can see here, the bear market's been relatively kind to Tesco shares, which are broadly unchanged over the past 12 months. That compares to a 25% drop in the FTSE 100 over the same time span, and I would suggest there are 3 reasons for that resilience. First, the acquisition of wholesaler Booker in 2017, albeit for a fat price, does look to be helping sales and earnings momentum at the group. Second, Tesco's announced the sale of its Thai and Malaysian operations for around £8 billion, with the cash going to erase the pension deficit and fund a £5 billion special dividend. And finally, panic buying of pasta, flour, toilet roll, to name but 3 consumer staples, does mean that the grocery giant's getting some respite from the market share war with Aldi and Lidl, as punters flock through its stalls so they can stock up, hunker down, and wait out the COVID-19 outbreak. So when it comes to the full year results, investors will look to 3 numbers in particular. The first is like-for-like sales growth, where the third quarter revealed a further loss of momentum in the face of pressure from those discounters. On a like-for-like basis, sales fell 0.9% year-on-year in Q3, so let's see what the final 3 months of the year brought. Attention will then move to the regional trends. In the third quarter, the UK slipped 0.4%, Asia by 1.6%, and Central Europe by more than 11% on a like-for-like year-on-year basis. The second headline number to watch will be pre-tax profit. The consensus forecast is for £1.98 billion before exceptional items, against £1.56 billion a year ago. Then the third number is the dividend. After a first half payment of 2.65 pence a share, analysts are looking for a full year distribution of 8.27p, up from 5.77 a year ago. Also watch out for comments on that planned cash distribution once the Thai and Malaysian disposal goes through. £5 billion equates to around 51 pence per share. Over and above those items, investors will look to outgoing boss Dave Lewis, for he steps down to replace after nearly 6 years at the helm by Ken Murphy sometime this summer, for any guidance for the new year. In case Mr. Lewis does feel able to say something, the consensus analyst forecasts are currently looking for an increase in pre-tax profit to £2.3 billion, and for a 10% increase in the ordinary dividend to 9.13 pence per share. In terms of strategic issues, shareholders will watch out for an update in the goal to generate synergies worth £140 million in total from Booker by January 2020, and a total of £200 million, or just over, by January 2021. Thank you for watching, and I look forward to speaking to you next time.